Hey everybody, welcome to my live stream. And we've had a really rough day today, to say the least. We had a day when the S&P is going down 2.79, the Nasdaq's down 4%. Holy smokes, man! What a rough day, a very rough day. But this could be a big opportunity. Let's see how things play out. It could be a really rough, couple of weeks, maybe couple of months. I hope it's not a couple months, but let's see how far we are going to see this market sell off. And when I look at the S&P, it is down at this point. If it closes right now, it's down 8.55 from the recent high. If we look at the NASDAQ, it is clearly in correction territory. We've got the market's down 12.88%. If it were to close at this moment, which we still got a half hour of trading to go. So it's a pretty bad situation out there. And what I am, I months ago I was talking about, just selling some of my really high performing stocks that just seemed like, they got a little bit of froth on them. The market seems really expensive, and I built up a little cash pile. Nothing like Warren Buffett, right? The Oracle from Omaha is a freaking genius, right? He's sitting on a ton of cash right now. He's probably the calmest guy on Wall Street. He's probably super calm and chill, just sitting on his big cash pile, waiting for this market to just completely collapse. Then he comes in and buys stocks super cheap. And he's been doing this a while. He exhibits patience when he needs to. And man, just one more lesson from the great Warren Buffett. For us, for us mere mortals, counting myself in the mortal club, I'm going to take advantage of this. I mean, I do have cash. I have a pile. I bought plenty of stocks today, and I'm going to buy more stocks tomorrow. So it's this is the game we decided to play, stocks with volatility. But it is proven, it's factual, that over time, stocks outperform bonds, they outperform other types of asset classes. So over time, big crashes and corrections prove to be an excellent time to buy stocks. So are we in the excellent zone? Not quite. Give me another 10% off the NASDAQ, and I will claim it's pretty obvious most stocks are going to be discounted. Right now, we still have to do our research, make good decisions. If you are new to my channel, what is the investing recipe for success for me? What is my thesis? Is I look for companies that are excellent businesses, and those excellent businesses drive free cash flows. I value those free cash flows based on a valuation model that I created, and I look for stocks that are discounted. These are excellent businesses that will go up over time. And when I buy them at a discount, expecting they will go up over time, I tend to be, correct most of the time. Sometimes I just pick a dog and it's bad, but I also pick some really good stocks. As we have this sell-off, I don't abandon my process. It's still the same process. The good news is some of these stock prices are lower. I'm going to talk about AppLovin a little later, and I bought AppLovin today. And that's a stock that I was critical of a month ago, month and a half, 2 months ago, when it really went sky high. I like the business. I just thought the stock price was too high. Well, the market took care of the stock price. It brought it down by like 55% from the top to where it's at now. Well, now I look at the stock and I'm like, that's a good looking company. It's a very good stock price. And I started buying AppLovin as an example. I'm a dollar cost average guy. I buy over time. I'm not smart enough to know today is the day when I should buy XYZ stock and just, put a big pile of capital into a stock. No, but I feel like I can buy a stock knowing that it's discounted and I can buy it over time. You know, I don't know how far down we're going to go in this market. We can go down for a little while. Right now, the NASDAQ's down 12.88%, and we'll see how far down it goes. Thanks for joining me. We're 18 strong. Mike, the dividend investor. It's good to interact with you throughout the day. I know it's a tough one. I hope you're making money somewhere. Market is making a small bounce. I hope so, man. Yeah, Warren Buffett, man. That guy's so freaking smart. He's got. I heard that Warren Buffett started investing when he was 11. He's 94, so that's 83, 83 years of wisdom. Go Warren Buffett. Mitch, good to see you. Thank you for showing up, sir. You want to take a look at FWRG. I will note that I've got some stocks that I wanted to go over, and we'll go over that one when I get done. High cost eggs are going to make omelet stocks cheap. That's a good way to say it. K, is it Hinth? And you want to take a look at TD. Glad to look at it. Just be a little patient. I've got a list of stocks I'm going to go over. And then Olarind, hey, would you consider Fannie or Freddie excellent free cash flow businesses, assuming they would be released? The short answer, every time I've looked at those, the answer is no, because they're kind of a government entity and they don't trade like a regular stock. And if that changes, maybe, but for the times that I've seen it, the answer is no. It's not something I would want to be involved with, because I don't think most investors consider it kind of a separate company. Shadow Guy, man, tonight I'm probably going to dream of being in the same room. I guess it'd have to be a warehouse with Warren Buffett and his cash pile. It's probably just, it's an emerald pile of cash. He's just sitting there waiting, like a wise investor waiting to invest. And he can't invest like dollar cost average, because as soon as he makes a move on a company, that stock's going to fly up, right? As it should, because it's probably good quality business. But, you know, Warren Buffett's not perfect. He's awesome. He's excellent. But he proves that you don't have to be perfect to make a lot of money. He's made a few investments that he cut his losses on, Paramount, and then the beauty company, forgetting their name just recently. But I could go back in time and point out, hey, he made some choices here that he got rid of, but he's made some brilliant choices at the same time. So good for him. All right, so let me take a look at the market a little further, and then we're going to get into taking a look at some stocks. So the NASDAQ is getting its clock cleaned. The Russell is also in the hurt zone. It's in the hurt locker. It is in a headlock. It is about to tap out or pass out, one of the two. It's down 17.47%. Holy Toledo. And the Russell, you know, it's kind of deceiving. You have a lot of small businesses, and when investors get scared, they sell off the small ones. Like, hey, I don't know this company as well as a blue chip stock. You know, I've known of, just throwing out an example, I've known 3M since I was knee high. So I'm going to go into 3M, or I'm going to stick to my 3M and sell all these small stocks. So they tend to be sold off at a greater extent because people want to keep their blue chips. The NASDAQ has a lot of tech in it, so that's where that's at. And of course, the S&P is kind of, this one's has a measure of the biggest stocks out there. It's down 8.63. So for sure, the NASDAQ's in correction. The Russell's in correction. The S&P is heading towards a correction. And the Dow is down 6.56. So the Dow is making it through this with the least amount of pain, but it's still pain. It's kind of like the NASDAQ has two broken legs and a broken arm. The Dow only has a broken arm. It's still in pain, but not as much. All right. So that's what's going on at large. looking at the heat map, boy, it's like looking at my screen. I can put my hands up to it and just feel the warmth of that red. The Nvidia stock, talk about a correction. I'm gonna take a look at Nvidia because I'm curious to see how low it's getting. It's pretty darn low at this point, and looks like Google and Meta are just getting shellacked. Apple, Microsoft, Tesla down 15%. Let's look at Tesla. Oh man, what a bloodbath. Tesla, I have to guess that stock's down at least 50% from its recent high. That is such a crash. Incredible. Walmart is down. What's the story out there that's making there's kind of a combination of two stories. The first one being, of course, the tariffs are not like making markets more comfortable. They're making markets less comfortable. They're making markets, concerned that, hey, prices are going to go up. This is going to create a lot of collateral damage. There's going to be a slowing down of the economy. Businesses are going to struggle, and that's coupled to, are we heading toward a recession? And I would say if you took a silent poll of people on Wall Street and investors and so forth, and you said, hey, it's a binary decision. Are we heading toward a recession in the next, call it 12 months, or are we not? I would say that most people would say we're heading into a recession. There's just factors that are getting us to cool down. And the consumer sentiment, unemployment's going up. There's a couple of factors out there where the story on a recession is beginning to take shape. Interest rates are dropping really fast, which is a sign that, hey, we're going into a recession. A recession means businesses make less money. They make less money, less profits, less cash flow. Valuations go down. It's all rational, okay? Got a recession, got to pull back on prices. Now, I'm not complaining about stocks being reduced to some extent, because over the last 5 years, the NASDAQ's up 122%. When you have an appreciation rate like that, and it's obviously not spread evenly among all stocks, we have some stocks that have gotten really frothy, and exuberance has been in display. Let me push some stocks out there. Nvidia, obviously, Nvidia is correcting. It's correcting to a price that I think investors will be willing to pay. Palantir, frothy. Robinhood, frothy. AppLovin, frothy. And all of these stocks have just been getting hammered because their stock prices were too high, which is why the NASDAQ has been doing so great. You have these stocks that can never go down. They just keep going up. And now we're getting a pretty good pullback. That's good. That's a good thing. We'll get stock prices that are more rational. We can make investments for the long term that are solid. I mean, look at this chart. The NASDAQ over the 1 year is only up 8.87. The NASDAQ in 2024 was up roughly about 25, 30%. So now we're like, okay, let's buckle up, because we got to do some analysis and make sure that our investments are solid. If there's a weak investment, not a bad time to get rid of it. And then look at those companies that I want to own more of and go pull the trigger on buying shares. In this live stream, I'm going to go over the stocks that I bought. It's a long list, but hey, let's cover it. I'll tell you why I bought it. I'll tell you why I'm buying it. And there's plenty to choose from. I mean, I'll start with one of my favorite stocks is Robinhood. We'll talk about getting your face ripped off as a stock. Is Robinhood got pretty beat up, 14%. Whew. Man, what a day. So that's where the indexes are at. We got a heat map that's telling us, all right, we got all these stocks that are going down. Wow. We'll take a look at a lot of these. I'm going to look at Meta, Google, Nvidia, Microsoft, Apple. I'll look at Robinhood, Coinbase, AppLovin, Lyft, Futu. I'm going to look at Chubb because it's doing well. I need to mix in some good news with all this bad news. Kroger, Elevance, those did well. Those are in green. You see healthcare is kind of holding it together. It's not getting, beat up like the other industries. You look at oil and gas, it did okay. You look at consumer staples, this is where Kroger operates. It did okay. Utilities. Now, I don't invest exclusively in especially consumer staples or energy or I don't even touch utilities because these over the long haul, they don't give me enough return. I'm looking for long-term rate of return. And I get that by investing in growth stocks, and especially these small caps, mid cap stocks that are just going to grow. They're going to take my money and multiply it. I put 50 grand in, and maybe 5 years later I get 100 or 150 grand back. That's what I want to do. So we are seeing a market that has a little bit of green but a lot of red. When we look at sectors, let me give this thing a refresh. And there's one sector in the green, that's utilities. Good old-fashioned boring utilities. But look at the 5-year. That is not good enough. I don't want to invest and get a 30% rate of return over 5 years. No, thank you. Energy, it had an okay day. I'm glad I own Chevron. Staples didn't lose as much as the rest. Healthcare did, compared to tech, which lost 4.36. It didn't lose as much. I'm not going to say anything good about down 1.5%. Consumer discretionary down big, and communication services down 3%. So it is a real solid down day, man. It's just a bad day. Our biggest stocks on the index, only one little green, Berkshire, with all that cash on their balance sheet. But everybody else, they're riding the pain train, going down in value. Notable, Tesla. They went from being like number 6 to number 11. Man, they have dropped. They have dropped so much value. They were above $1 trillion in market cap. Now they're 700 billion, which is still a really valuable market cap. Interesting. I think the semiconductor stocks, TSM, Broadcom, Nvidia, they're going to keep dropping. It's, the whole story of, hey, AI is going to be so wonderful and data center is just going to be limitless capital is going to go into data center. No, that's just not, that's irrational. That's exuberant thinking. Is a data center going to get bigger? Yes, but it's cyclical. Businesses will invest, look for ROI out of the investment, double down on a positive ROI investment. If they don't, they're foolish with their capital and investors will abandon them. Stock prices will go down. So that's what's going on with the big caps. All right, looks like we've got 35 people on the live stream. Thanks for joining, everybody. We're going to get into looking at some stocks. And it looks like Carlos, you're on. Very good to see you. Jay Zev, good to see you again. Talk about falling knives. Yeah, man, this was like a horror movie. This is like Halloween. Jason chasing us around Wall Street. Omar, very good. Yeah, I mean, this is a good day to buy stocks. I know it's a crummy day, it's terrible, but you get discounts on great companies. If you focus on the company and you believe that company is going to be worth a lot more in the future, why not buy when it's discounted? No worries. So CODIS, CAD, would you buy Google and Amazon? I'm going to go over both. So let me answer that in a little bit. So we'll go over Google and Amazon. Okay, so let's start with Robinhood. Robinhood, oh my gosh, down 19%. What a horrible day in the neighborhood. When we have a stock down 19%, it's what a day. Holy smokes. Over the 1 year, this is still a winner. It's up 110%. This is a good business. I imagine, I don't know what trading volumes are today, but this bear markets are not good for brokerages. So um, this stock is a good company to have long term, but it may have a tougher 2025 than I thought of before. Now, it's a $32 billion market cap. PE, forward PE is 25, and it's discounted by 70% according to analysts. So when we look at that, the company's growing really nicely, 58%. That looks good. And just the company has a lot of things that I like. I like that how they go about their business. They kind of go after parts of the market that they think they can really dominate, and they've been doing that really well. I still think like Robinhood is a nicely discounted stock. When I say discounted, I'm looking at a company and I'm trying to assess what are the future cash flows that this company is going to produce. Most of my valuation is based on free cash flows, and I forecast the next 4 years. I think they can hit this forecast, and then after that is the terminal value, and I'm going to grow that by 5%. I'm going to grow the first 4 years by 20%, and that's my cash forecast for Robinhood. I discount at the discount rate of return, gets me a value of all those cash flows of 64 billion, and they have close to $5 billion of cash on the balance sheet. Goes to show how much cash they're generating. And when you compare that versus their current market cap, it is a very, very different two numbers. The value of the cash is 117% more than their current stock price. That's why I think Robinhood is such a good opportunity. So I really like Robinhood because of its cash flow generation. I like their uniqueness. I like how they go about their business in the market. They don't try to be all things to all investors. They pick their markets and then they go after them. And I think they're going to do just fine over the long haul. So did I buy shares of Robinhood today? You betcha. When you give me a discount like you were offering today, stock market, I will buy some shares. So I bought Robinhood today and will continue to buy if they're going to be discounted at that rate. I'm good buying into that company. It's been a winner on my portfolio, and I am good to go with Robinhood. So Robinhood's the first one out of the gate. Pretty good example of what's happening today. Today, stocks are just getting smashed. They're getting so smashed. And even Robinhood year to date, it's only down 5%. How is that? How could it just be down 5%? But it is. It's just down 5%. So that is Robinhood. Now let's look at the next one I want to look at is Coinbase. And Coinbase is a similar story. Now, what was a big surprise is cryptocurrencies got a lot of attention last week. There was a whole, hey, the US government's going to establish a reserve. And I thought that was going to really benefit Coinbase. Surprise, it didn't. It didn't benefit Bitcoin. It didn't benefit Ethereum prices. And then Coinbase, as a result, sold off. With the really scared market, that accelerated the selling, and Coinbase is down 18%. Wow, that is a big, big drop. So Coinbase, overall, I think very similar to Robinhood. These guys, they don't do all things for everybody. They focus on crypto. It's the most trusted name in crypto from a brokerage perspective. I know some people don't like them. I get that. We don't all like all companies, but I happen to think that investors have the most trust in them. I know I have a Coinbase account, and I trust Coinbase because they're publicly traded and I can see their financials, and that's why I have a Coinbase account. So those things said, I think Coinbase is unappreciated. It is discounted according to analysts. It's being discounted a lot today. I bought some shares today, and I think that Coinbase continues to be a good discounted stock. And when times get tough like this, the Coinbase stock will be sold off. If this follows the pattern that we observed in 2022, this stock will be sold off. Right now, Similar to the Robinhood example, the cash flows that I expect from Coinbase are worth 79% more than the current stock price. So to me, that's just a good situation. Very good risk reward, meaning I believe the Coinbase business is here to stay. I think they're going to have a very successful future. Having said that, in 5 years, I believe the Coinbase stock is going to be worth far more because of these cash flows. So I will buy more shares. I bought more shares today. And now with the new pricing, it just looks like a good investment. So I'm glad I built up some cash so I can buy shares. I dollar cost average in my purchases into stocks. I'm not brilliant enough to know on this particular date, that's when I should buy. But I do know that Coinbase is a business that drives cash flows. I can put some analysis, try to get to a forecast that I think is going to be doable for them, then value that forecast. And when I do that, I see a very good upside potential for Coinbase. So that is Coinbase. Moving on to AppLovin. This stock had an incredible rise. And I like showing AppLovin in Google because I could really show how dramatic the rise was. When you look at this stock, I mean, it went up fast. From August to February 19th, it went up 638%. This is where exuberance kind of gets out of hand. This is where frothiness, it's like having a cake and it's all icing. It's like, no, you got to have some substance. You got to have fundamentals behind it as the basis of that cake. And this stock here has really, really collapsed. When we look at the year to date, I think that'll tell us a story. It's really come down 53% in less than a month of trading for a high quality business. I've studied this business. I've covered it for a year. I think the AppLovin business is a quality business. They're growing really well. They're profitable, generating high amounts of free cash. So as I have mentioned before, I was waiting for the stock to come down to a price where I thought was a good investment, and it happened. Today it happened. So I started buying AppLovin stock. When I look at the AppLovin fundamentals, I see really good things. As mentioned, they are growing their top line revenue, which is the measure of, is this business really doing well? Doing well in the respect that, hey, more customers are buying their product. The customers that had been buying their product are buying more, different products, and they're willing to pay higher prices. So that's the measure that the revenue growth tells us. The free cash flow tells us how darn profitable are these guys? Do they have big fat margins? Do they get to keep most of that money that gets represented in top line revenue? In the case of AppLovin, absolutely. They keep a lot of that cash. They do about $2.1 billion of free cash flow now. Now they're growing it so fast that I'm growing that cash flow. So my forecast says it's going to grow by 20% the first 4 years. So this is an incredible rise for a strong business, really strong business, which is why it just took off like crazy. I think professional investors love AppLovin and retail investors loved it, but they just took, the market itself, right? It just took off. It took off too fast, too high, and now it's come back down. Now, is it going to settle down at the stock price it's at today? I don't know. Can it go down another 10, 20, 30%? Absolutely. So that's why I DCA. I'm going to DCA into App as so long as I see that the cash flows are worth more than the current stock price. So that's how I'm playing AppLovin, and I'm beginning to buy shares beginning today. And interesting how quickly this one turns. Sometimes I have to wait a year, 2 years to be able to enter into a stock. In this case here, it happened fast. Man, did it happen fast. So incredible. AppLovin, here we go. So that is App. Let's take a quick look at Tesla. Tesla is just having a tough time. And I want to look at Tesla using this charting here so I can see what the total from the high to where we're at now. So this thing peaked in December. And from December to this point, it's down 54%, basically what AppLovin has experienced. So 54%, and if today they're a $700 billion market cap company, that means that they went up to about 1.4 trillion. So there's been roughly $700 billion of value that have gone away from Tesla. Wow. Oh man, it's incredible to be able to say that. It's like, wow, I mean, $700 billion of market cap of investments left Tesla stock and went somewhere else, probably into cash, bonds, somewhere safe. Really, really incredible drop. Now, Tesla doesn't have great fundamentals. It is a business that I don't consider to be all that valuable. The reason for it, it's a car business, right? And some people say, no, it's a technology business. Well, maybe, maybe not, but geez, they're assembling a lot of cars and shipping them to people. So I guess I'm going to keep thinking that they're a car company because they sell so many cars. And those cars, they don't make a whole lot of money out of each car. In fact, their free cash flow is not very good. These guys are, at one point, they're 1.4 trillion market cap company. They generate 3.5 billion of free cash flow. I just showed AppLovin, they just did 2.1 in 2024. And that's a far smaller revenue company than Tesla. So Tesla just inherently doesn't have as much value because their primary business is making cars. And those cars, you don't make a lot of money. So when I look at it from a fundamental analysis, the Tesla stock is still, even at the current stock price, 83% too high because the intrinsic value of Tesla based on the free cash flows they're producing is much lower. Tesla investors may feel like, hey, just Tesla's going to be something big and valuable in the future. I just know it because their CEO is a genius. And you might be right. You might be right. But that's just not the lane that I drive in to invest. I look at fundamentals and I look at what that business is worth. The CEO is not part of my formula. My formula is what's this business worth? What are the margins? What are the free cash flow rates? And Tesla just has always been just too expensive. I owned Tesla a long time ago, like 10 years ago, and I really bought it without having fundamentals behind it. I just thought it was a cool company, and I was right. It was a lot of people liked it. So I bought shares and I kept them for a while and then I sold them. But that was just a fluke kind of investment that once in a while I might buy a stock because I think the company's cool. But I shouldn't do that all that often. I should follow a process, get to fundamentals, and make good decisions. So that's where we're at with Tesla. Man, what a drop. They dropped $750 billion of value over months. Wow, incredible. All right, so those are some of the stocks I wanted to talk about. Let's talk about some of the stocks that you want to talk about now. And let me catch up on some comments here. We are 47 strong on the live stream. Thank you so much. If you just joined, we're looking at stocks. We're going to look at them. We're going to look at fundamentals. We're going to see if we can value the companies quickly based on their free cash flows and see if their stock prices are either where the stock is discounted or priced at a premium. So looks like Mike, the dividend investor guy, you're MDB. MongoDB, is it crushing it? Are you making a ton of money here? No. Okay. So Mongo, I mean, it didn't go down too much today. It went down a lot when they announced. Remember, they announced they went from 264 and they dropped like 20% or something. So I guess the drop was already baked in. They dropped another 4%. But on a day like this, boy, that's nothing. But it's been going down. This one here, as mentioned, I think we covered it. I just don't see a whole lot of specialness in their business. They're growing at 19%, and they're a small company in the software space. They're a database software company, and they have big, strong competitors. And those competitors have really good database products, so they're going to have a hard time growing. If they're not growing really fast at a small company scale, then it goes to show that, hey, you don't have anything special there. And not only that, you don't make a ton of money. You don't have a lot of cash flow. Their gross margins are good. They continue to lose money. because they don't have the big scale just yet, and their free cash flow is good, but it doesn't substantiate that big market cap that they have. 120. Let's say I paid, yeah, not nowhere even close. I can't even get close to 14. I can barely get to 3 billion in market cap value based on that free cash flow. So, that's what I'm seeing out of MongoDB, and it'll have to drop quite a bit for me to be interested. I wouldn't really be interested a whole lot because they're not a leader. It's not. There's other companies that are in the leadership position for database. These guys are kind of making some noise on the edges, but not going at the heart of this industry. So I'm going to stay away from Mongo. But I hope it works, man. For your sake, I hope it really works. Mike, Hood's trade volume is up 74.2 million shares. You bet. Oh man, what a day! Holy smokes! So, Paul, good to see you. And what do I think of Meta and Google? I'm going to answer that question. It's already on the list. Hang tight. I will cover them. And then Android PC, good to see you. Mitch, I just got Robinhood Gold and Coinbase canceled my account for inactivity. They seem like competitors now. Yeah, in a way, absolutely. I think they do want to compete for your investing in crypto. The difference being is Coinbase is very focused on, hey, we're crypto only, where Robinhood is like, hey, we're a variety of investments. We even do your banking. So Robinhood's a little more rounded and kind of diversified, where Coinbase is just really, really single threaded. All right, so it looks like Sabir, good to see you. Sergio, yeah, I'm with you. I'm traveling, Sergio, so I don't have my little studio that I usually stream from. And sorry about the mic quality. I think once I get on the streaming software, it kind of makes everything, all the noise, all the sounds get muffled to some extent. So sorry about that. I'll just have to deal with this for the next week and a half. Sabir, what small caps do you buy today? That's a big question. I'll try to cover some. I'll show you some small cap examples today. Michael Anthony, you bought Lyft at $11, which I bought Lyft at $11.50, which like the fundamentals more than Uber. Yeah, I mean, I own a lot of Uber. I own a little bit of Lyft. Overall, I think Lyft is showing a better discount, but I think Uber is just a stronger play. they're going to dominate the space. I think Lyft's a good opportunity because I think other players want to be a part of this space, and they'll probably acquire Lyft at some point. I'll cover Lyft. I've already got it on my list. I'll cover it a little later. You want to talk about Arista? And I went over Arista a couple weeks ago, maybe a month ago, and I said Arista was overpriced substantially, and I got some comments that were pretty critical of me. You don't get it, and maybe they're right. We'll take a look at Arista, but the stock's way down from even that point. But so are a lot of those stocks. Neil Weston, SoFi is out. What do you mean SoFi is out? Is there an earnings announcement? We'll take a look. Take a look yesterday. I couldn't resist CRM today. You bought. Nice. Well, I am a CRM stockholder. Nothing what I say is financial advice. I don't recommend you buy, hold, or sell any stock I cover. I'll just share with you my analysis and also share which stocks I'm buying and selling. Hopefully you find it interesting. We'll take a look at CRM a little later. Prefer Thresh. Could you check Reddit? Could maybe. I guess maybe you sent me a message there. I'll definitely check later. All right. So Mike, the dividend investor guy. Yep. So maybe CRM will get there. All right. So back on the list. Now we're covering stocks that you guys want to look at. I'm not going to sway from my process, which is I want to look at fundamentals. I want to look at revenue growth. And we're going to start with First Watch Restaurant Group, right? Yeah. And I'm going to look at growth of the revenue. I'm gonna look at cash flow, profitability, try to assess what's the general value of this business. Do I think there's an opportunity for a good discount, or is it just priced too high? Let's take a peek. So this is a small cap, 1 billion. The forward P is a little high, 46. This is a restaurant. First Watch Restaurant Group, through its subsidiaries, operates and franchises restaurants under the First Watch trade name in the United States. The company was formerly known as, okay. All right, so it's a restaurant. Analysts like it. It's a strong buy. Over the 1 year, the stock's down 27%. Year to date, it's down a little bit, not too bad. And today it was down 4.74, and the aftermarket down 3%. So when we look at their financials, they have good growth. Now, restaurants could be a little deceiving because restaurants tend to grow when they open new store locations. So you got to check to see, is there organic growth or is it new store openings? Organic growth is the best. New store openings could be positive, but we don't know for sure. So check that out. You got to make sure you check that out. So 19% growth is there. They are producing no free cash flow, minus 4 million, and they never really produce very high free cash flow. Okay, that's a problem. I need cash flow to value a business. Gross margins are really low, 22%. Not a lot of money left in the restaurant, right? You got to buy ingredients, fresh ingredients. You got to hire people. You got to have a lot of people working in that kitchen. Kitchens are really expensive in restaurants. And then you got to lease out really expensive real estate. Just a lot of cost that goes into that business. So it's not really desirable for me. I think I've said it many times at restaurants, I just don't buy restaurant stocks. The closest I got to is I made a little money on Starbucks. That's as close as I want to be to a restaurant because they just don't make a lot of money. Gross profit, profit margin is really low. Really not really good there. So in general, this is just a total pass for me. There's no way I can get anywhere near a valuation of $1 billion because right now they don't have free cash flow. If I use 2023, the best I can do is maybe get to $100 million of overall market cap, but they're a $1.1 billion company. It's just not going to happen. I'm not going to get near $1 billion. I wouldn't spend a whole lot of time evaluating it because there's just not enough cash flow involved. Analysts will use earnings per share, so they'll give you price targets based on earnings per share if you just value it using earnings per share, and they think it's discounted. Now, another thing I don't like about restaurants going into this year, we're already talking about a recession. If you have a recession, people are not going to go to restaurants as often. They go to the restaurant, they're probably going to try to save a few bucks. So I'm just not a buyer of the stock. It's not the right stock for me. I can't get a valuation anywhere near their current market cap. So thanks for asking about that one. Hopefully you found my comments interesting. Next one on the list is TTD, Trade Desk. So we looked at this one a few times. People keep asking about it. I think this big drop is causing people to think, hey, is this a good opportunity? Is this, buy the dip situation? But when we go into the financials, we go into the quarterly, the revenue is good. The growth is good. I remember finding something that was a problem. Let's keep going. So revenue is good at 25% revenue growth for the year. That looks pretty darn good. When we look at free cash flow has been expanding. That looks good. Okay. Gross margins of 80% looks stupendous. So that looks good. So what's the story? Why is this stock so undesired right now by the market, selling it off like it's going out of business? So 641 at their current growth rate, I would say this business is worth 12 to 20 billion dollars. And let me check the balance sheet here. They got more cash than debt. Looks good. Yeah, their cash flows don't get me to 30 billion. I can get you to 20 billion, but I can't get any higher. It's a good business, good cash generated, but not enough, and good margins. Um, they just got to crank out more cash, and they have good margins. So I'm not quite sure how they're going to do it, but the market does not like them right now. They've gone down like 48.69% year to date, and really it started to drop February 12th. So in less than a month, this one's dropped close to half its value. Even after that, I can't get to their valuation. It's not like Robinhood. Robinhood, I could exceed their valuation. So this one here is a pass for me. I've looked at it. This is probably the third time, and each time I get to the same place. It's overpriced, and it hasn't changed. And today was down 7%. I mean, it's got to be a painful ride for investors, maybe that bought around here, because you lost half your investment. That's got to be super painful. So that one there is a total pass for me. Let's look at um, Nvidia. In Nvidia, I'm going to look here in this chart here. Nvidia is an awesome business. I always start with the respect that I have for Nvidia. It's a terrific business, smart people, but it's a cyclical business. Cyclical businesses don't have smooth upward revenues. They have really spurts of growth, and then demand waves, and then it grows again, and the demand waves. That's just the way the semiconductors work. The stock has been struggling for quite a while, really since the end of May until now. It's been dead money, and we're probably 2 months from lapping those numbers, and this thing is going to be in the negative for the year, which is going to be psychologically tough on investors. This one here is I value it in the 90s, and I still wouldn't buy it in the 90s, because that just means that the momentum is going to be to sell off Nvidia. Right now, I mean, geez, some of these stocks are just getting hammered. My price target on Nvidia is $91. And I thought their earnings were excellent. Even when I put those excellent earnings into a model that I believe is going to be reasonable to expect, I can only get to 56% of their value. The stock's overpriced by 44% based on free cash flows. So Nvidia is a pass for me. I don't even know if I'd buy it at $90 a share, because I'd be scared that, hey, the thing's going to keep dropping. It's not like I can buy it and then be sitting on a stock that I feel is heavily discounted. I'd probably wait until it got to like $70 a share. As insane as that sounds, I mean, the stock has come down from like 150 to 100 and wherever it's at. Let's see, the high point for Nvidia here was 150, close to 150. So when we measure this point to where we're at now, this is down 28.4%. This is a big cap. This is now a $2.6 trillion market cap company. At some points along the way, it was like 3.4 trillion. It's lost a lot of market cap. And I don't know that it's ever going to exceed 3 trillion. Would not be surprised if the thing goes down to like 1 trillion in overall market cap. There's just a lot of things that were priced into the stock where people just thought, data centers, companies are going to put so much money into data centers, and capital is a finite resource, or a finite amount. Businesses can only invest so much, and then they'll go bankrupt, or they'll just not be able to do it. And the Nvidia story, the Nvidia expectation was, no, they'll just keep spending because AI is going to be such a great business, when it hasn't proven to be a great revenue creator and a good profit generator. It hasn't. So for now, I think investors are realizing there's going to be an eventual loss of demand temporarily for NVIDIA technologies, and competition's catching up, and new ideas are coming out. Like DeepSeek came out, and it really kind of knocks the whole AI establishment on its side. Like, hey, you guys were doing it really expensively. Here we are doing it less expensively. Well, heck, everybody wants better software, better technology at a more affordable price. So I think that's it's going to be interesting to follow. but I don't know that a lot of investors are jumping into Nvidia right now. I certainly wouldn't jump in too early. I got plenty of choices to pick from. I mean, got AppLovin coming down 50%. I'll invest in that stock. That one's on its way up, growing really nice. It did get euphoric, but now the market is taught, I guess, those investors a little lesson, which is you get euphoric, you will be punished. So Nvidia is not looking good, but who is? Who is on a day like this, right? Everybody's getting hammered. Everybody's getting their 20 pounds of pain today. This is down 5%. Year to date, it's down 20%. Whew, man, tough. Several people asked about Google. So let's take a peek at Google. And Google, I'll start with my valuation. Google right now is looking good from a numbers perspective. I am a little worried about their strategy, and I'll comment on that later. When I look at their cash flows look great. Although their capital expenses really brought down their free cash to some extent, it's still the value of those cash flows is still 13% higher than their current share price. So it looks good. It's a superb business. I mean, Google search, YouTube, their cloud business looks great. Waymo looks great. Just really good businesses. So I like that. Their earnings per share drive a better valuation, and collectively, I think it's a stock that I feel like is 35% discounted. So I own a lot of Google Alphabet. I bought shares today. I couldn't resist. When the market pulls back like that, just really irrationally, it tends to be an automatic buy. I'll buy it, and it's discounted, so yeah, I'll buy it. So Google Alphabet's looking good. Now their strategy, they got to make sure that they respect the fact that the market didn't like that they're spending so much darn money on that data center. So let's not get too into that data center and lose money. You can see that over the 1 year, it's still up 23%. At certain times, this thing was just doing great, but it's given up those gains. In a way, that's kind of healthy, right? You don't want a stock that has the AppLovin experience. This thing's up 176 over 5 years. Mission accomplished. Nicely done. Google Alphabet, awesome business. One of the top businesses in the world. So this one here, I bought more shares today, and I feel good about that. I think the stock has been coming down as of late and presented a really nice stock price to investors to consider. So that is Google Alphabet, looking good. Amazon also went to the barber and got a really nice haircut in 2025. And everybody's getting a buzz cut. That's what is in fashion for these companies. They are, let me look at this chart here to kind of measure how high they got and then how low they've gone. What's interesting about Amazon is the market kind of has kind of a love-hate relationship with Amazon right now, and it's down 19%, but I mean, that's not as bad as some other stocks. So it's not like, oh my God, Amazon's, falling off a cliff. But if you look at just the 1 year, look at this sell-off that the market thought, Amazon's a bunch of, knuckleheads. No, market, I think you're a bunch of knuckleheads. And I bought a bunch of shares here. And since then, it's just been on a really nice rise. It went up really clearly. The market was wrong. And now the stock's really still up 20% from that low. But it's really has a love-hate relationship with Amazon. That is so interesting. Amazon's another one of those really, really valuable businesses. Top 5, top 6 business in the world. Who cares who's number one? These guys are the best at what they do, which is e-commerce as well as their data center business. Their cash flows have been going down because they're spending so much darn money on that data center. So it made them a little bit less valuable when we look at their cash flows. That's what changed in my valuation. And I stopped buying shares of Amazon. And I sold a few shares just to create that cash pile, make it a little bigger. But now the stock is presenting a slight discount. Now, as this thing sells off, I'm going to continue to buy. It's not, you don't have to ask me twice to buy Amazon. Amazon's a great business. If I could buy Amazon at a discount, I will buy it. These guys are going to be worth a lot more in the future. This is one of the most, valuable businesses in our economy, in the global economy, and I want to be a part of it. So I will continue to buy shares in Amazon. Looks really good. I think it's slightly discounted. Any kind of pullback, I am a buyer. Next one, let's talk about Arista. What's going on with Arista? And I did Arista Networks as a video. I put it on my channel, and I did get some good quality feedback. And FYI, if you have a different point of view on a stock, you are welcome to put it on any one of my videos. I actually like seeing when another investor thinks differently than I do. I probably have something to learn from you. So please bring criticism and stuff to my videos. I will read everything. But on this case here, I stuck to my guns and said, I just don't believe that Arista's worth what they're worth. And I think it was this big drop that, and leading up to that drop, I was making videos on Arista saying, I think they're overpriced. And the reason for it is when we go to the fundamentals and you look at Arista, let's call it a $100 billion business, or at least they were above that for a while. And you look at their free cash flow, it just doesn't support that number. Free cash flow is $3.6 billion. At their growth rate, 20%, there's a lot of 20% growers, and these guys are not the biggest company in the world. Some people might say, yeah, but they're in the right sector. They do a lot of cybersecurity. Maybe, but last time I checked, they're principally a networking company. They compete predominantly against Cisco. So this growth is going to continue to be a little tougher and tougher over time, especially as they get bigger. The best I could do is like a $70 billion valuation on this company, and they're way up there near 100. And they were higher than that. And when I kind of shared that analysis, some people, they just thought differently, and that's cool. We don't all have to invest in the same stocks, but I'll share my analysis and hopefully people find it interesting. It's one more investor sharing how he goes about things. And on this one here, I just thought it was overpriced. And I think these analysts are all basing it on earnings per share. They think the stock's going to double in value, according to some of them. And they think the stock's highly discounted. But I bet you within a couple months, these price targets are going to go down big time, because you're going to see that this business is going to see a lot more competition. It's going to see an economy that is beginning to pull back on some of its spend. And then Arista is going to begin to see a further loss in its stock price. So Arista really ended up going in the direction that I thought it was going to go. And you can check the videos that I did on Arista. That's what's cool about it. Having a YouTube channel is it kind of locks in what I said 3 months ago, 6 months ago, a year ago. Check NVIDIA. I've been saying stuff about NVIDIA that ended up being somewhat correct over the last year. And, that's good. And in some cases, I get it wrong, by the way. But on those two examples, Arista and NVIDIA, I got it right. And to some extent, I'm getting Broadcom right. To some extent, I'm getting other stocks that I will talk about. I've gotten, I think the valuations that I gave them over time have proven to be somewhat correct. All right, so that's Arista. That's enough of Arista. Let's talk about SoFi. SoFi is a crowd favorite, and it comes up so often. People love SoFi. And this stock here, holy moly, what's going on here? Man, look at this. It's got a nice mountain shape. And, SoFi, I think it's great how they're growing and what they're trying to do. I think it's great. I just don't think it's as lucrative as other businesses. And when we look at, from their high to where they're at now, down 37.5%. And I just can never get a high valuation for SoFi. And every time I talk about SoFi, I'm like, I'd rather own Robinhood. I'd rather own other like New Holdings. And that's the thing about stocks, right? There's no rule that says I have to buy SoFi. There's no rule that I don't have to buy it. There's no rules, period. I get to pick the stocks that I want to pick. And in some areas, like in financial services, new generations financial services, I get to pick between SoFi, Robinhood, New Holdings, PayPal, you name it. And out of that bunch, I pick the ones that make the most sense to me and that I can get a clear valuation and a clear expectation that stock is discounted and I can make money on it. So SoFi's never fit my model. It's never been a stock that I could say, I think this stock's worth, twice its current value. It's just never been. I've covered SoFi 10 times because it gets requested so often. So keep requesting it. If people like it, people like it. But so far, I mean, and you can't say that SoFi is the only stock that's losing a lot of value, but this one's lost a pretty good amount of value. It's a $12 billion market cap. It hasn't risen like a Robinhood. Forward P is a little high at 43. Analysts say hold, and it's only discounted by 9%. So I'm not the only one out there with a little bit of concern around SoFi. So that is SoFi. Thanks for asking about SoFi. CRM, then I'm caught up on my list. All right, so CRM, Salesforce, down 3.5 on a day like this. It's not the worst, that I've seen out there. This thing's selling off, and Salesforce is such a strong business. They're number one in their category. They are the dominant player in CRM, Salesforce automation, service, and so forth. There's some other companies that want to compete against them, but none of them are as big as they are. They also have a real advantage when it comes to AI applications. I think these guys are going to deliver real AI. I really do. And Salesforce, I think, is a good business. They're a really good business. They've grown organically. A lot of their growth here that you've seen, that's true organic growth. 8%, let's call it 9, round up a little bit. And you look at their margins, excellent margins, 77%. Booyah. Then we've got free cash flow at 12.4 billion. 12.4 billion. Woohoo, nice. So when I look at a valuation of CRM, that cash just adds up really fast, and their growth rate is really good. So I put it in a model, and I say, based on their growth rates, their free cash flow, I'm going to grow up by 10%. They're actually growing faster than that. Their cash flow is growing faster than their revenue. 10% growth rate, I think, is doable for them. In the first 4 years, they'll grow by 10%, and then after that by 5%. If their AI business really is a hit, it's just gravy. It's just additional value on top of this. And when I look at those cash flows and discount them by 8% to today's present value, it's $484 billion. That's a lot of value. They have more cash on the balance sheet than debt. And overall, they're worth $490 billion. But their current market cap's 261. So it's a huge discount based on the cash flow value of CRM. That's why I'm buying CRM. They're a dominant player, number one in their category. I don't think anybody's going to argue that. They drive great cash flow, proven grower, very well run business. I want a piece of it. That's why I'm buying CRM. So that is CRM. We just covered 2, 4, 6, 8, 10, 12, 14 stocks. Nice. Thank you for suggesting all those. We got more comments coming in. They're coming in fast and furious. Let's take a look here. Let's see. Where did I leave off? So Mike, the dividend investor guy. Okay, so we covered CRM. We covered SoFi. Give me a second while I read through these. Michael Anthony. How you doing, man? It was good to see you on Prad's stream and share a few ideas on his stream. I'm probably going to watch his stream later. See what, man, I wonder what he's going to say on a day like this, man. Oh, traders. Today, the guys having the party were the short sellers. They must have just been like, super happy. It was like a day of Disneyland for them. Okay, you want to talk about Lyft, Michael Anthony. I think somebody else did. So we're going to handle Lyft next. And you think NVIDIA can fall to 75? It could. Man, at this rate, this market, I don't think anybody's, going to argue that this market can fall another 10% on the NASDAQ and on the S&P. We're on our way down. Now, again, let's go back to, I heard something, I actually read it on X, which was genius. Warren Buffett was quoted as, what history has taught us is that most people don't remember history. And the reason being is the market will show you examples of great opportunities, and then quickly people forget about them. So let me remind you of one that should be an opportunity in the making. We're potentially entering a range that resembles, and again, potentially, this isn't what's going on just yet, but beginning at the very end of 21 up until, let's call it 9-10 months later, the S&P, which is more stable than the NASDAQ, went down 25%. Whew. You had Netflix discounted 80%, Meta discounted 80%. I mean, some of these, Nvidia was down 65%. Some of these, the best businesses were just getting smashed. And people who said, yeah, it's a great opportunity, I'm buying, they're the ones that won. They went up 70% collectively in 2 years. They put 100 grand in, they're getting 170 grand back in 2 years. If we keep on this trend, this is going to happen again. So you come back to my channel, I'm going to keep reminding everybody. Yes, it sucks to see our portfolios get smashed. It sucks. I think I may have set a personal record today of my portfolio losing the most value, but it's just temporary. I still own the awesome companies that I own. I have cash to deploy. I got work to do, because if the market's going to do something like this, I want to take advantage of it. And then I will flourish like I did from this range to this range. I'll even go back in the history books a little further and say, what did I do? How many shares did I sell when we had the big COVID scare? I sold 0 and I bought more. And that was great. It was a great move. So let's go back to the Great Recessions. How many shares did I sell and how much did I invest? I invested big in that era, and I actually invested in real estate in that era, and I did really well. Go back to 9/11, similar flash crash. I bought more. I did not get out. I did not sell one share. So again, I'm not selling one share that I wouldn't have sold. I sold 2 stocks today. I sold shares in Hewlett Packard, the PC company. I had already made that decision. And I sold shares in Nike. And I'm selling shares in Nike because I think they're going to struggle. The economy's not kind of going their way. If you have tariffs on China, they're probably going to get mad and slap Nike with lots of problems. And the US government's probably going to not want product to be made in China. Those 2 decisions were made outside this correction. So it's not, hey, this correction's scaring me and I'm selling those 2 stocks and I'm creating more cash. I have cash piles and I have some bonds that are redeeming. So I've got more cash coming. This Wednesday, one of my big bonds is going to redeem and I'm getting a nice cash infusion into my overall portfolio. So right now is a good time to study the companies we want to own and see how they're selling off and see how we can buy them at a really good discount. So it is going to be a good time to invest and make money over the next couple of years. All right, so we're going to go over Lyft and then Mitch. So you get a lot of SoFi ads. Interesting. So do I like Citigroup? I do like Citigroup. I made money on Citigroup. We can take a peek at it. I'm not buying any more shares. I'm just keeping my shares where they're at. I think it was the best opportunity out of the big banks, and I was rewarded. Really nice return on Citi. Am I buying more shares? No. Am I buying shares in big banks? No. I think right now there's plenty of problems to go around, and banks are going to have some problems. So, Mitch, you want to look at CCJ? We'll take a peek. I don't even know what that is. Tesla is done. Hopeless, man. You know they're done when Hopeless has a comment like that. All right, so CSA SAC. Follow Nancy's money bags to the top. Maybe. I really don't. She could do whatever she wants to do. It's interesting what she does, but no thank you. Paul the Fast. Do you think Meta should be broken up? No, I don't think they should. Is Bob in Baba we trust? Baba's been doing great. They didn't get as beaten up today as possible. Chegg, man, I haven't looked at Chegg in a long time. Maybe Chegg's going to pick up a rally. Nichix, Uber. I've been buying into Uber. It was already attractive for me, and I'm bought more shares today. Tesla going to zero. You're buying into Uber and Zim. Zim is kind of in a weird place because I think their management may take it private. So I think that's having a kind of a weird effect on the stock. I'd like to buy Zim at a certain price level. I don't know if they're going to hit it because now if they go through with it and they take the company private, it's probably going to keep the stock price where it's at or near it. So, all right. So, Michael Anthony, RDW. Don't remember that one. And then Car Kais. What do you think of Reddit stock? I looked at Reddit maybe 2, 3, 4 weeks ago, and it was priced too high. I think that they had a really nice earnings where they showed a lot of subscriber growth and so forth. And then, the big dominant player that is Google changed their algorithm, and then boom, a lot of the users dried up for Reddit. It was a little bit of, don't forget who the 5,000-pound gorilla in search is, and that's Google Alphabet. And now, I mean, the Reddit business looks okay. Just remember, Snapchat was super cool, I don't know, 20, 25 years ago, 30 years ago. They never rewarded investors to the extent that Meta did. The big dominant players in social, they tend to take most of the spoils. They tend to dominate. And I own Meta, I own Google Alphabet. I don't know that I'd buy a whole lot of Reddit. I valued the company, and I just didn't think it was a good buy for me. But I can go over it again. In 2 days, Zim gives earnings. And, I tell you, I like Zim. I've made money on Zim. I like them. But let's take a look. I've heard some things on Discord. I heard them from a very reliable source. Another investor, he's a paid investor. I've gotten to know him really well, and I trust everything he said. And he said that there was going to be the management team's looking to take the company private, which could be Zscaler. I like Zscaler. Zscaler, I did a video on very recently, like in the last week. Just excellent earnings. Stock really rose, but it got shellacked today along with the rest of them. I bought Zscaler stock today, and I can go over it real quick. And then K, is it Hune? What do you think about TMDX? I'm not sure what TMDX is, so we'll take a peek. All right, we're 63 strong on this live stream. Let's keep rolling. We got to look at these companies and see where there's opportunity. We left off on Lyft. Now, why am I looking at Lyft? I'm a big Uber shareholder. I own a lot of Uber shares. This guy, the reason I looked at it because it came on a live stream. One of the cool things about live streams is you guys take me to places where I wouldn't go on my own. And somebody asked about Lyft, and we looked at it, $5 billion valuation. Oh, okay. And then they're trading for less than their revenue amount. Okay, that's weird. PE, forward PE of 10.6. Okay, that seems really affordable. Well, are they growing? Absolutely, 31%. All right, well, I really like that number. And how about their cash flow? Free cash flow, 766 million. So if you just multiply 7.66 times 10, which would be a very reasonable valuation on cash flow, you get to 7.6 billion. But it's 31% growth. You really should go 20 times. So we're up to like 15 billion in valuation. But wait, how much cash do they have? Do they have a lot of debt? And you're going to like this answer. They have 2 billion of cash, about 1 billion of debt. So they have about $1 billion of cash ready to go, just sitting there. And they make another 750 per year. And that's growing. Their rate of cash flow growth is really high. So all kidding aside, the fundamentals just stop me in my tracks. Yeah, I get that I'm an Uber stockholder, but geez, man, this thing's valuable. And their valuation's super cheap. And I threw a few bucks here. It's not a whole lot of money, but I would not be surprised if these guys acquired. They have had a horrible ride. Their stock price is really rocking, and then they were sold off and they were deemed to be undesirable. Our friends at Uber, they're the dominant player. That's where I put most of my capital. I'm going to keep my capital in Uber because they're an excellent company. Over the 5-year, Uber has really done well. I'm glad I own their shares. And when we compare Lyft, they haven't kept up with Uber. Again, I'm not buying Lyft to replace Uber. I am buying Lyft because I think it's a good opportunity, and we'll see how it plays out. They've been selling off. They sell off more harshly because it's a small cap and people don't believe in Lyft as much as they do. But when I look at the fundamentals, man, I cannot say no to fundamentals like that. 30% growth rate, great free cash flow, great profit, business is growing. Throw a few bucks over there, see what happens. The market doesn't agree with me just yet. We'll see over time if the market appreciates the Lyft stock and rises the stock higher. Let's talk about our friends over at Citigroup. Citigroup is an investment I made when, it was early, and I'm glad I did so. I was buying into Citi back here, and I took a nice ride up the elevator, up the escalator, and it's really rewarded me, which has been great. I'm not buying any more shares. I think the stock is nicely discounted, like 15, 20%. I think banks have the economy to deal with. If there's a recession, I think banks are going to struggle. I think the tariff thing kind of throws a monkey wrench in economies. And I think these guys are waiting for just all this noise to go away and for them to understand what kind of economy are we going to have. And then banks will start to work again. So right now, I'm just pumping the brakes on any more shares of Citigroup. I bought at the right time, and I'm just sitting on my shares. Right now, and I value banks differently than the companies you've been seeing. I should not value banks based on free cash flow. It'd just not be right. So I value them on their book value growth as well as earnings per share. When I do that, these guys are discounted by 37%. This pullback just happened. But I'm just a little too concerned with this economy and as it relates to Citigroup. So I'm just going to wait. It pays a decent dividend. It got a good number of shares. I don't need to sell the shares. If I see opportunities in tech or in pharma, biotech, communication services, where I'm like, I got to create some cash, I'm probably going to sell my Citigroup shares because I think I can make a good return on Citigroup, but I could also take advantage of a market that's scared and maybe put that money to good use in tech or another space. This over the 1 year up nicely, but really when you measure from here to here, that's where the money's at. This is the move that I bought into Citi before that move, and I'm sitting on a good gain. So go Citigroup. And I wouldn't buy, like I was a JP Morgan stockholder for a long time. I wouldn't buy any banks right now. That's what I'm not doing, I guess, is something I would say. All right, so we're going to hit CCJ. What is CCJ? Don't know what that is. Let's take a look. What is CCJ? Cameco Corporation provides uranium for the generation of electricity. It operates through 3 segments: uranium, field services, and Westinghouse. So uranium, huh? This is in Canada. All right. 1 year, hasn't done anything, pays a tiny dividend. 5-year, whoa, look at that. It's done something in the 5-year. So these guys are $40 per share, $18 billion market cap, $2 billion revenue company. So forward P is 44. So they're growing nicely, 21%. This is a materials company, I believe. No, it's classified as an energy company. Okay. 21% growth, very good. Free cash flow looks good, 693. Okay. The margins are not great, 33%. And let's take a look at their debt levels. Sometimes these businesses have a lot of debt. So total debt's 900 million. Cash is 400 million. Not too bad, but there's some debt out there. Debt to EBITDA is 1.64. No worries. So this business, just back of the envelope, is worth about 13 billion. And that's a pretty generous valuation because their margins are pretty low. But even with that, their cash flow is good. So if I multiply that times 20 minus debt, I get to about 13 billion. So I think it's being priced a little too expensively based on free cash flows. The earnings per share, Charlie Munger hated earnings per share. He would not use it. He valued companies on free cash. And I would say that can give you a far different valuation because it's really using earnings per share. And there's a lot of financial engineering that can be put into an earnings per share number. So I'm not even going to go there. I think the company is priced too high in my book. So that's CCJ. Alibaba. How did Baba do today? It went down with everybody else, 575. This has been a really nice winner this year. It's still up 56% for the year. It hasn't gotten that long-term down. Like since February 19th, a lot of the growth stocks have been just heading down. Baba hasn't done that. It's kind of kept its value. So that's very good. Very good to have Baba have a big position. Ford P is 13, strong buy. Looks good. I did buy some Baba shares today. I couldn't resist. Got to buy. If the market's going to be all crazy and erratic, I will take advantage of it. Now they're growing single digit, about 6%. They're a big business. This is in the Chinese yuan, which I believe is 0.14. So it's a pretty big business. The margins are going to be okay because it's a mix of businesses in there, but the free cash flow is really good. I have a full valuation that I could just jump to because that's in US dollars. And I can show you what I think Baba is worth based on free cash. So Alibaba is worth 18% more. Their cash is worth 18% more than their current market stock price. So it's a nice modest discount because the stock's up so much. But it's been one of those stocks where I just felt like it was a good company to have. If anything, it was my big stock in China, and it really came back to reward me here at the end of 24 and at the beginning of 25. It's been one of the stars of the show within my portfolio. Right now, I am beating the market, but I'm still a little underwater now, especially after today. I was making money as of before the market opened, but I'm sure today I'm going to be in the red by probably like 2%, but the market's in the red far deeper. So I'm doing okay thanks to Alibaba and a couple of other names that have been doing just really, really, really well. So Alibaba's just been doing really well. What's going on with our friends over at Chegg? So Chegg is this company that does a lot of services for students. And this stock, man, 80 cents a share. Oh, man. Oh, can it get any worse? It's down 90% over the 1 year. It's down almost 98% in the 5 year. Incredible. This was a darling back in the COVID days. And now it's like not desired by anybody. Look at the PE, 6. Discounts 283%. When was their last earnings? April 28th will be their next earnings. So that's another month. So that means that back in January, they had an earnings report. And it's just showing a lot of red, a contracting business. That's not good. That's not good at all. Your business is getting smaller. Customers are leaving you. They don't like your services. You are generating some free cash, but the writing's on the wall. Maybe they can sell their business to somebody because, man, look at this valuation, $84 million. Man, what's going to happen to this business? Interesting. You're buying them for a fraction of their revenue, and they are turning some cash and they are going to make some money. So, man, if you're a risk taker and you think these guys are going to start, if anything, not contracting anymore, but if they start to grow, this is immediately going to double, triple, quadruple your money. This one is because it's 80 cents a share. If they got to like $5 a share, multiply your money times 6. But it's a big if. And are you going to take that risk, right? I'm going to evaluate the stock and see what the heck. See if it's something that I want to get involved with. All right, so let me take a quick peek at Uber. Somebody asked, we talked about Uber, but I didn't show you the valuation. So we'll take a look at Uber. I think Uber is an awesome business, leader in the market space, and I think their cash flows are worth 106% more than their current stock price because I take their existing cash flows and I grow them based on a growth rate of 15% for the first 4 years. That gives me just beautiful numbers. Look at these huge, chunky numbers because Uber has got this scale, right? And when they grow, they don't have to buy a bunch of cars and hire a bunch of people. No, the drivers buy the cars and the drivers are contractors. So they don't have to pay a bunch of money. They could just keep growing their business pretty much without limit. Isn't that great? And they were growing really well internationally. So I just love where they're at in the marketplace, dominant player, and their cash flow is going to continue to grow really nice. And robotaxi is going to be an opportunity, not a threat. I think the market's now realizing that, hey, AI is not going to move that fast. We're not going to have awesome AI use cases in 2025. Maybe we'll have them like in 2030, but it's going to take a while. In the meantime, Uber's going to get bigger, stronger, faster, more profitable, and I'm going to go along for the ride. It's been a really good investment so far. I just think it's a really terrific opportunity for me. I bought more shares today. You've heard me say I bought more shares in a variety of stocks. You got it. Pretty much every stock in my portfolio, with the exception of like Citigroup and others, I threw some money at it. I'm like, okay, this market's kind of out of its mind, and I'll take the discount. I'll take the discount across the board. If it did that 10 days in a row, I would buy 10 days in a row. So Uber was one of those stocks that I bought shares in. Terrific company. RDW. Redwire Corporation. What do these guys do? Redwire Corporation provides critical space solutions. Space economy. Most space economy companies lose a lot of money. Yep. A lot of money lost. Small cap. Revenue is okay. Not making any money. They're growing nicely. They're losing money. And they're burning cash. So I'm a fan of space, but I'm not a big investor in space companies. Look at their forecast. 6 analysts cover these guys. They may pick up their growth, and they may get profitable in 2 years. Call me when they start generating free cash. I can't invest in a company like this. So the space industry is one bad launch from having a massive problem. Like, these guys are down 15.63 in the after hours. I guess they reported their earnings. The market didn't like what they saw. So these guys here, it's just not something that I want to invest in. I'll be a fan of space, but I won't be an investor. I'm a fan of great fundamentals. That's what I invest in. So that's somebody else's investment. If they really feel like they understand the space economy and they think there's going to be great economics, go for it. I don't. I'm not going to pretend I do. I have a better sense in other industries, and I'll go make a lot of money in those other industries. So it's a no for me on Redwire. good luck to anybody else that invests in it, and hope you make a lot of money on it. So it's Reddit, right? So Reddit just didn't value very well. Wow, they were down 20% today. They haven't had a good year. Well, speaking at 2025, right? So they're down 34% year to date. Over the 1 year, it's up 215. The IPO'd. It's been a successful IPO. They really went up when they showed that they were growing their users, but it's really come back down, right? It from the October timeframe, I guess early November timeframe to now, it's you're kind of even, Steven. I looked at their fundamentals, and the last quarter I think is where we saw user growth go down. They're still growing really nice. That growth looks awesome. Free cash flow looks good. They're growing it. So they're at 1.3 billion in revenue. They're growing at 60%, which is phenomenal. Free cash flow at 215. So if I multiply 215 times 50, then I would get to about 10 billion, maybe 12 billion, right? And they're at 20 billion. So yeah, I can't get there on this one. There's too much to be determined on this one. They could begin to underperform, and then you got a 50% loss. There's a lot of things that can move this stock from a $20 billion market cap to 10 if things just don't work out. If they do work out, they can grow into that valuation. Maybe at a later date, I can be more interested in Reddit. But for now, I think based on free cash flows, this stock price is too high. It's probably 40% too high. Analysts will be in love with the growth and say earnings per share are going to carry this stock up really nicely. And they can continue to believe that. I invest on cash flows principally, and the cash flows tell me that Reddit's priced too high. And that's been the case as I've evaluated the company a few times, and it's the case again. So Zim, what's going on, Zim? Look at this. Holy smokes. Now, this is a big winner when a stock only goes down 0.63%. Man, it's such a good winner. After hours, it's up a little bit. It's going to announce earnings on Wednesday, and the stock is done okay, 87%. I made money on this. I bought it last year, and I sold in the fall. I sold somewhere around here or here. I think it was here is when I sold. I sold at a nice gain, and I moved away from the stock. It looks like I didn't miss anything since then. The stock, I do have a buy order on it, but it's down at $17 a share. I don't know if it's going to get there. I've heard that, a management buyout. So if that happens, they'll take the company private and the shares will be traded private. It's an interesting company, but shipping stocks will never be priced based on their, intrinsic value. Just shipping is so darn cyclical. Investors are always afraid, yeah, buy the stock and then shipping rates collapse and the stock price collapses by 50%, if not 80%. So that's always lingering out there. Shipping rates really collapse, so do stock prices in shipping companies. So that's what I think is the apprehension that investors have in companies like Zim. So, but I like the company. It's really well-run company. I just think the company's great. You just got to know when to buy and when to sell a company like Zim. Zscaler is a good stock, really good stock. They're still positive for the year to date. They're doing really well. They're growing nicely, almost 30% growth, good profit, great margins. And I think the stock, I'll just cut through the chase and go to my valuation. I think the stock is discounted because they're growing really well and they're growing those cash flows. So the value of those cash flows, they continue their growth rate is 81% higher than their current stock price. So this is just a really neat little company. It's not the biggest company in the world, and I think their growth rate proves that they're doing certain things in a really effective way. So I like what they're doing. I'm glad I bought them. This was the one that I picked out of the cyber security stocks. I don't have a big investment in them. I have bigger investments in bigger software companies, but this one here I thought could use, or I could put some capital to work. I'm glad I picked it. I believe in it, and I keep buying shares. I bought more shares today. So that is Zscaler. It's a good one for me. And then TMDX. So TMDX, Transmedics Group. Let me read here while I sip my coffee. So these guys do organ transplant transportation. Okay. $2 billion market cap, 441 in revenue. 4P is a little high. They do services, right? So this is like med device and healthcare. Okay. That makes sense. 82% growth rate. That's pretty incredible. Margins are okay at 60%. Looks pretty good. They're cash negative. That's a problem. So these guys are cash negative for the year, trailing 12 months. They are beginning to generate cash, but it's premature to do a valuation on these guys because I just don't know what they're going to be worth. Nice growth rate, phenomenal growth rate. So their growth is going to slow down, and they're not generating free cash, so I can't give a valuation on this. It seems like a neat business. How's your stock been performing? Year to date's okay. It's been giving up a lot of stock price in the past, and it did really well for the 5-year, but it's really contracted from September up until now. And one thing to check is what's their debt level? Not too bad, just $181 million of debt. Debt to EBITDA. Whoa, it is kind of high. Their EBITDA is kind of low, so it shows that they do have a pretty good debt level. But 181. So I'm not trusting that ratio. Gross profit. Yeah, I don't trust that ratio. I think they're fine on debt. So this one here, I mean, you can, if you really believe in this business, maybe it's a good investment. Well, you're not doing it on a free cash flow valuation because you just can't get there. They don't have any cash flow to put into a model and say, hey, this is what this business is worth. So this one's a pass for me. The business doesn't have the fundamentals that I need to put into my process. So, all right. So we've been going for 2.5 hours, folks. That's been a pretty good run. We've covered, about 35 stocks. And I don't know about you, but I'm getting a little tired. So let's shut this thing down. And can you evaluate Omar? So PSX, what's PSX? Phillips. So this is an oil company. Oil companies are going to be, it's all about oil price, and these guys, yep. And I think they're more downstream, like they're selling the product to the consumer. They're not growing, but they generate a lot of cash. These companies generate really nice cash. Free cash flow 2.3 billion, but it's gone down. Well, that's a concern. I think because oil prices are down, so they don't make as much money when oil prices are down. Okay. So 2.3. Yeah, this one's a little expensive in my book. I think Chevron and Exxon look better. And there's a lot of choices in oil. The dividend is okay, but Chevron, Exxon pay a really nice dividend if that's what you're after. This one does not look good to me. It doesn't have the same kind of risk reward situation for me. And look at Michael Anthony coming in, wait until $100 on PSX. So, all right. So, hey, everybody, we're 50 strong on the live stream. Really good live stream. I really appreciate it, but I got to shut this thing down because I am a little spent. I just covered, 30, 35, 40 stocks. We were fast and furious, but a day like this was pretty furious. Look at all the red, man. But there is some green out there. We just got to figure out, where do we invest, man? How can we stay away from all the cruddy companies and pick the diamonds that are going to sparkle in the future. All right, so everybody, if you like this kind of evaluation, this kind of analysis, this kind of thesis, this kind of philosophy, I encourage you to be a paid member, because then you get to come on private calls. We go over things. We have workshops. We go through this, slow it down, see if we can analyze companies. My hope is that you improve your skill set in being involved with this community. So I would really appreciate if you can consider that, being a paid member. You can see the details on the video details, and it's pretty affordable. I think it's worth it, and I'd appreciate you being a member. For all those that are paid members, I really appreciate your support. Thank you so much. So everybody, hang in there. This week's been rough, and we'll see if it stays rough. But let's just hang in there, and over time, find those opportunities that are going to make us a lot of wealth in the future. This is not a one-night deal where, hey, I'm going to buy a stock, it's going to double by tomorrow. Yeah, that's never been a thought in my mind. But what I want to do is make a lot of money every year and keep getting better and keep getting, my wealth level, raised each year. That is my mindset, and I think we can get there. So everybody, have a terrific evening. Let's go lick our wounds and get ready for tomorrow. Let's get our buying all set up, take advantage of these prices. Take care, everyone. We'll see ya.